If you are sitting there right now listening to this, and you've recently felt that heavy, sinking feeling in the pit of your stomach, you know the one.
Oh, yeah. Everybody knows that feeling.
Right. That feeling when a project just completely fizzles out, when a
Yeah.
side hustle flops, or you send out, I don't know, 30 resumes and get 0 interviews.
Or you make an investment and it immediately bleeds red.
Exactly. The natural human instinct is to look at that string of duds and think, well, I am failing. I am doing something fundamentally wrong. I'm broken.
Which is such a normal reaction.
It is. So I want to speak directly to you today, the learner. Because if you have ever been overwhelmed by a track record of misses, this deep dive is going to completely dismantle that anxiety for you. We're going to look at a landscape of global, monumental success that is built almost entirely on a mountain of absolute garbage.
It really requires a total paradigm shift. I mean, we are socially conditioned from a very young age to view a miss as a definitive judgment on our abilities.
Right, like you get an F on a math test, you are a bad student, period.
Exactly. But when you look at the actual mechanics of how the most profitable systems, companies, and creators actually operate, that schoolhouse logic completely collapses.
It falls apart entirely.
Yeah.
And I want to kick us off with a quote that I think perfectly captures the reality we're exploring today. It's from Brad Pitt.
Oh, this is a great quote.
It's so good.
Mm.
He was accepting a Screen Actors Guild Award a few years ago, and he's looking back at this massive, iconic career. And he stood at the podium and said, I've been banging away at this thing for 30 years. I think the simple math is some projects work and some don't. There's no reason to belabor either one. Just get on to the next.
The crucial phrase in there is the simple math. He isn't being falsely modest, you know. He intuitively grasps the mathematical law that governs our source material today.
Which is a concept we can call tails, you win.
Right. Tails, you win.
Okay, so let's unpack this immediately. Because when I hear the word tails, my brain goes straight to a coin flip. Heads or tails. A 50-50 shot.
Sure, yeah. That's what most people think of.
But we are talking about something entirely different here.
We are talking about statistics, specifically the shape of a distribution curve. So imagine you take thousands of events, say the lifetime financial returns of every single company in America.
Okay, I'm picturing it.
And you plot them all on a graph. The vast majority of those companies are going to lump together right in the middle. They do okay, they survive, they make a little money, maybe they lose a little.
Just normal everyday businesses.
Exactly. That giant lump in the center is the average. But as you move away from the center, out toward the absolute furthest edges of the graph, the extreme winners and the extreme losers, the line tapers off into these long, thin lines.
Ah, okay.
Those extreme microscopic edges on the far left and right, those are the tails.
So a tail event is basically an extreme outlier, something that happens maybe 1 in 1,000 or 1 in a million times.
Yes. And our mission today is to prove, using historical data and hard mathematics, that these rare extreme tail events don't just happen occasionally. They dictate everything, literally everything. They drive the entire economy. They drive the stock market. They drive culture. We are going to show you that in the real world, you can be wrong half the time, or even 99% of the time, and still end up making an absolute fortune.
Which is such a wild premise to wrap your head around. It completely invalidates the idea of perfection.
Oh, entirely.
Because we are taught that perfection is the ultimate goal. But if tail events drive the world, perfection is actually a terrible, unrealistic metric.
Striving for perfection in a tail-driven world isn't just unrealistic, it's actively harmful.
How so?
Because it limits the number of swings you take. If you understand the mechanics of the long tail, it fundamentally alters your relationship with failure. A high volume of failure isn't a sign of incompetence at all.
It's not.
No, it is the mandatory mathematical prerequisite for a massive success.
I love that phrase. Mandatory mathematical prerequisite. Let's ground this right away with one of the most incredible stories from our research. I want to introduce you to a man named Heinz Berggruen.
A truly enigmatic figure in the 20th century.
Completely. So the year is 1936. Heinz Berggruen is a young man, and he's forced to flee Nazi Germany. He eventually makes his way to America, and he enrolls at UC Berkeley to study literature.
Right.
Now, looking at the biographical data, there was nothing particularly world-altering about him at this stage. He wasn't some known prodigy. He was just a young immigrant studying literature, trying to find his footing in a new country.
There were absolutely no early indicators that he would become a global titan of finance or culture. None.
But you fast forward to the late 1990s, And Heinz Berggruen is universally recognized as one of the greatest art dealers to have ever lived.
Which is just a massive leap.
It's crazy. And in the year 2000, he took just a portion of his private art collection, which included an absurd number of works by Picasso, Braque, Klees, and Matisses, and he sold it to the German government for over 100 million euros.
Which, we should clarify for context, was effectively a charitable donation to his home country.
Right, because the actual market value was way higher.
Exactly. The actual private market value of that specific collection was estimated at well over $1 billion.
$1 billion, amassed by a guy who started with nothing, dealing in a medium that is entirely subjective.
Yeah, art is tricky.
It's so tricky. This is where my brain demands an explanation. Because art isn't an engineering problem. You can't look at a Picasso in 1940, run a stress test on the canvas, and definitively prove it will be worth $50 million in a few decades.
No, you can't.
It's paint. It's emotion.
Yeah.
So how does one person foresee exactly which specific paintings are going to define a century?
Well, the standard assumption is that someone like Berggruen possessed a supernatural level of skill. The narrative we like to tell ourselves is that he simply had a golden eye that allowed him to see aesthetic value that everyone else completely missed.
Yeah, I mean, I instantly picture him as this highly trained sniper. Yeah, I imagine him walking into a gallery in post-war Paris, surrounded by hundreds of struggling artists. And he ignores 99 paintings. He doesn't even blink at them. He just stares through his scope, waits for the exact right moment, the exact right light, and boom, he buys one flawless Picasso.
That is a very romantic image.
Right. He takes his shot, never wastes a single bullet, and builds a billion-dollar empire, one perfect decision at a time.
It's romantic, the lone genius with flawless execution. But researchers at the investment firm Horizon Research dug deeply into the mechanics of how great art collectors actually operate, and they completely dismantled that sniper analogy.
Really? So he wasn't a sniper?
Not even close. The reality is far less romantic, but infinitely more useful for anyone trying to navigate risk today.
So how did he actually do it then, if he wasn't picking them off one by one?
Horizon Research found that Berggruen didn't operate like a sniper at all. He operated like an index fund.
Okay, we need to pause and define that, because index fund is a term thrown around on financial news all the time. But the mechanics really matter here. What does an index fund actually do?
Think of it this way. If you want to invest in the stock market, you generally have two choices. You can try to be a sniper and pick the one stock you think will win. Say, you put all your money into Ford.
Hoping Ford beats everybody else.
Exactly. Or you can buy an index fund. An index fund is a financial instrument that simply buys a tiny piece of every single company in the market. It doesn't try to guess if Ford will beat General Motors. It just buys both of them, plus Apple, plus Microsoft, plus thousands of others.
So you are buying the entire haystack instead of looking for the needle.
That's a perfect way to put it. You buy the haystack.
So you're saying Berggruen bought the haystack?
He bought massive, unprecedented quantities of art. He didn't walk into a studio and painstakingly select one perfect piece. He bought entire portfolios. He bought everything an artist produced in an entire year.
Wow. Just sweeping it all up.
He bought works he probably didn't even particularly love, simply to acquire the volume. He blanketed the walls with lead, knowing that he couldn't predict the future of subjective human taste.
He used a shotgun.
A massive shotgun. And then he just waited. The Horizon Research analysis concluded that the great art investors held these massive quantities of art for a sufficiently long period of time to allow the portfolio's return to converge upon the return of the best elements in the portfolio.
Okay, let's translate that math for a second. The suggestion in our research is that perhaps 99% of the individual pieces Berggruen acquired over his lifetime turned out to be worth very little.
Think about the physical reality of that. We are talking about thousands of canvases sitting in storage facilities for decades.
Gathering dust.
Taking up space. Essentially dead weight, financially speaking.
But the underlying law of the long tail is that the 99% failure rate doesn't actually matter. It is mathematically irrelevant, so long as that remaining 1% turns out to be a Picasso that appreciates by 10,000%.
This is the critical insight about the mechanism of tail events. Berggruen was wrong the vast majority of the time. If you audited his collection piece by piece, you would label him a failure over and over again. Dud, dud, dud.
Just a warehouse full of duds.
Right. But because the upside of a true cultural masterpiece is exponential, because there is no ceiling on what a billionaire in the year 2000 will pay for a Picasso, that tiny 1% tail drags the entire dusty, failed portfolio into the realm of a billion-dollar fortune.
It just pulls all the dead weight up with it.
Exactly.
I can hear a skeptic pushing back on this, though. I mean, art is kind of a unique beast. Canvases are cheap. If you're an art dealer in the 1940s buying unknown artists, the cost of an individual dud is just a few dollars and some storage space.
That's a fair point.
Right. It's easy to absorb a 99% failure rate when the cost of a swing is negligible. But does this math hold up in an industry where one single attempt requires massive capital, huge payrolls, and grueling labor?
So you're asking if the long tail applies when the cost of failure isn't just a dusty canvas, but potential bankruptcy.
Exactly. And to answer that, we have to look at the birth of modern animation. Specifically, the incredibly grim early reality of Walt Disney.
Today, the name Disney feels synonymous with inevitable success. It's a total empire.
Oh, completely.
Yeah.
But the path of that empire was paved with brutal, suffocating failure.
Yeah.
We look back at the late 1920s and we see Steamboat Willie. It introduced Mickey Mouse. It was a massive cultural hit, and it put Walt Disney on the map.
Right.
But cultural recognition did not equal a sustainable business. Disney's first animation studio actually went completely bankrupt.
People always forget that part. The mechanics of hand-drawn animation in that era were just punishing. We are talking about artists meticulously hand-painting 24 individual frames for every single second of screen time.
Just staggering amounts of labor.
It was an incredibly labor-intensive, capital-intensive manufacturing process.
Because it was so expensive to produce, and because he was constantly trying to push the boundaries of the medium, Disney was forced to take on debt at outrageous, predatory terms just to keep the lights on. He was churning out short animated films, trying to find a formula that would actually turn a consistent profit.
And did he find it right away?
Not even close. By the mid-1930s, Walt Disney had produced more than 400 cartoons.
400 separate, distinct, massively expensive creative projects.
And the staggering reality is that the vast majority of those 400 cartoons lost money. They might have been liked by the people sitting in the theater, but financially they were bleeding the company to death.
Yeah.
Disney was effectively a man drowning in a sea of his own beautifully animated duds.
He was taking hundreds of highly expensive shotgun blasts and missing the target of financial sustainability almost every single time.
Until 1938. That is the year Disney releases Snow White and the Seven Dwarfs.
Ah, the ultimate cultural tail event of the 1930s.
Let's look at the sheer scale of the anomaly that Snow White represents. In just the first 6 months of its release in 1938, that one single film earned $8 million.
To understand the magnitude of that, $8 million during the Great Depression was an astronomical sum for any film, let alone a cartoon.
Unheard of.
It was an order of magnitude higher than anything the studio had ever conceived of earning. It shattered the ceiling of what animation could actually be.
It transformed the company's reality overnight. All of that suffocating debt from the 400 failed shorts, gone, wiped out immediately.
Wow.
The key animators who had been grinding away for years on unprofitable projects, they finally got massive retention bonuses. And most significantly, the sheer cash flow from that one tail event allowed Walt Disney to purchase a massive plot of land in Burbank, California, and build a state-of-the-art studio.
The same physical studio lot where the Walt Disney Company still operates to this day.
Right.
The bedrock of a modern media monopoly was purchased by a single outlier event.
So here is the philosophical question we really have to wrestle with. By 1938, Disney and his team had drawn and produced several hundred hours of film. But in strict cold business terms, the 83 minutes of Snow White were all that actually mattered.
Yes.
So do we look at those 400 failed cartoons as wasted time? Or were they the necessary, painful tuition he had to pay to buy the winning lottery ticket?
They were the mechanism of discovery. And this is why society so often misunderstands how success is manufactured. Anything that is huge, profitable, famous, or culturally influential is almost universally the result of an outlying one-in-thousands tail event.
Right.
But human attention doesn't work that way. We don't see the failures.
We only see the tail.
Precisely. We naturally gravitate toward the blockbuster. We watch Snow White. We don't watch the 399 bankrupting shorts that preceded it. Because society's attention is entirely captured by the massive hits, we drastically underestimate how incredibly rare those hits actually are.
We assume Snow White is the standard. We think, well, Disney is a genius, so he made a masterpiece.
And by assuming it's the standard, we completely discount the brutal volume of failure required to fund it. Disney needed those 400 fail shorts. He needed them to train his animators. He needed them to figure out how to synchronize sound and color.
He was building the machine.
He needed to test what audiences cared about. The 400 Dougs were the 99% of the index fund that allowed the 1% tail to eventually emerge.
But let's push this even further, because Disney was a visionary creator. Berggruen was a rogue art dealer. They were individuals making bets. I want to know what happens when you strip away the romance of the lone genius entirely.
Okay, where are we going with this?
What happens when an entire multi-billion-dollar financial industry explicitly designs its entire operating model around the law of the long tail?
Ah, you're talking about venture capital.
I am, because venture capital isn't about building a company. It is literally the business of hunting for tails.
That is their entire mandate.
I have some data here from an investment firm called Correlation Ventures, and I want you to walk me through the underlying mechanics of this because it seems borderline insane to a normal person. Correlation Ventures analyzed over 21,000 venture financings over a 10-year period.
That's a massive sample size.
Huge. These are professional investors, the supposedly smartest money in Silicon Valley, placing bets on tech startups. What does a VC expect to happen when they write a check?
To understand the data, you really have to understand the biological mechanism of venture capital. It operates very much like evolutionary mutation.
Biological. How so?
In nature, a species produces thousands of genetic mutations over time. Most of those mutations are useless or actively harmful, and those organisms just die off.
Right, survival of the fittest.
But every once in a while, a random mutation provides a massive survival advantage, say, a longer beak or thicker fur, and that one single anomaly redefines the entire future of the species.
So a venture capital fund is basically funding thousands of corporate mutations.
Exactly. When a VC firm makes 50 investments in 50 different startups, they aren't hoping all 50 succeed. They walk in on day one fully expecting half of them to die, to go completely to zero.
Just light the money on fire.
Yep. They expect another chunk to just limp along, maybe returning the initial capital, but effectively going nowhere. The entire financial model hinges on the mathematical certainty that one or two of those 50 mutations will adapt to the market so perfectly and scale so aggressively that they return 50 or 100 times the initial investment.
Let's look at the actual numbers Correlation Ventures found across those 21,000 investments, because the failure rate is staggering. Out of 21,000 highly vetted, professionally funded startups, 65% lost money.
2/3 of the time, these brilliant financial minds actually destroyed the capital they invested.
65% just evaporated. Moving up the curve, 2.5% of the investments made a 10x to 20x return. That's a solid win.
Very solid.
Just 1% made more than a 20x return. And the grand finale, half of 1%. Roughly 100 companies out of the original 21,000 earned a 50x return or more.
And that half of 1% is where the vast majority of the entire industry's profits are generated.
That is wild.
100 extreme tail events carry the absolute financial weight of 21,000 bets.
It's mind-boggling. But I know what the listener's thinking right now. They're saying, sure, that's Silicon Valley. That's a bunch of 22-year-olds in hoodies trying to build AI rocket ships in a garage.
Right, it's inherently risky.
Everyone knows startups are wildly risky, and most of them fail. That's why I don't invest in venture capital. I'm a responsible adult. I put my retirement money into the stock market. I buy safe, stable, publicly traded companies.
It's a very comforting narrative. The idea is that once a company crosses the threshold of an initial public offering, once it rings the bell on Wall Street, it somehow sheds that chaotic, tail-driven mutation phase and becomes a permanent, safe fixture of the economy.
But the research absolutely shatters that illusion. We have data from JP Morgan Asset Management that looked at the Russell 3000 index since 1980.
We should definitely clarify what the Russell 3000 is. It is not a niche index of risky tech stocks. It is a broad, heavily diversified collection of the 3,000 largest publicly held companies in the United States.
The big guys.
It represents about 98% of the entire investable U.S. equity market. These are the companies making your toothpaste, building your cars, and managing your bank accounts.
The safest of the safe. And yet, JP Morgan found that since 1980, 40% of all Russell 3000 component companies lost at least 70% of their value and never recovered.
Let that sink in. 4 out of 10 public companies experienced a catastrophic, permanent loss of value. They didn't just have a bad quarter, they were effectively wiped out.
Almost half of the stock market is a graveyard. And on the flip side, effectively 100% of the index's overall returns over that entire 4-decade period came from a mere 7% of the companies.
7% of the companies carried the other 93%. The exact same long-tail dynamic that governs volatile tech startups governs the boring everyday stock market.
I want to dig into why this happens, because looking at the breakdown by industry, this phenomenon spares absolutely no one. The data shows the percentage of public companies experiencing catastrophic loss by sector.
What's at the top?
Technology is at the top. 57% of public tech companies crash and burn. Telecom is at 51%. Energy is at 47%.
Which kind of makes sense. Those are dynamic industries.
But it goes all the way down to the most boring sectors on Earth. Utilities, the companies that literally just pump water and electricity to your house, have a 13% catastrophic failure rate. How does a water company go to zero?
Because the mechanisms of failure are diverse and inescapable. A tech company fails because a competitor invents a better microchip. That's a technological shift. But a utility company can fail because of a localized economic collapse.
Like a town drying up.
Exactly. Say a major factory leaves a town, the population halves, and suddenly the utility's massive infrastructure debt can't be serviced by the remaining ratepayers. Or regulatory shifts cap their pricing while inflation drives up their maintenance costs. Complex systems are inherently fragile over long timelines.
The research highlights a specific cautionary tale to ground this, and it is fascinating. The story of a company called Carolco.
Oh, for anyone who grew up in the 80s and 90s, Carolco was an absolute titan of pop culture.
They were the kingmakers of Hollywood action movies. Carolco was an independent film studio that produced some of the highest-grossing mega hits of the era. First Blood, Rambo, First Blood Part 2, Terminator 2, Judgment Day, Basic Instinct, Total Recall.
These weren't just profitable movies, they were cultural phenomenons that completely redefined the global box office.
Because of that unbelievable string of hits, Carolco goes public in 1987. They are added to the Russell 3000 index. By 1991, they are doing $500 million in revenue. They have a market capitalization of $400 million.
And market capitalization is simply the total value of all a company's shares of stock. So Wall Street was looking at Carolco and saying, this machine is worth $400 million. It was peak establishment success.
They had made it. But the movie business is the ultimate winner-take-all market. You are only as good as your last tail event. And in the mid-90s, Carolco's tails ran out.
They hit a cold streak.
A freezing cold streak. They funded a massive, big-budget pirate movie called Cutthroat Island that became one of the biggest box office bombs in history. They backed another expensive flop called Showgirls. The debt piled up rapidly, they couldn't service it, and by 1996, just 5 years after peaking, Carolco filed for Chapter 11 bankruptcy. The stock went to zero.
A total catastrophic wipeout.
The reason we are talking about Carolco isn't because it's some freak, unpredictable tragedy. We are talking about it because it is the norm. Carolco is just one of thousands of companies that make up that 40% failure rate in the Russell 3000. They rode a tail event up, and they were crushed by the gravitational pull of the average.
But this introduces the ultimate paradox of the stock market. We just established that 40% of the companies in this index effectively go bankrupt or suffer catastrophic loss. So logically, you would assume the index as a whole must be a terrible investment, right?
Right. If a car breaks down 40% of the time, it's a lemon. But how did the Russell 3000 actually perform from 1980 to today? It increased more than 73-fold.
73 times the initial value. It is one of the greatest wealth-generating engines in human history.
Despite almost half the companies failing. Because the 7% of extreme winners, the Apples, the Amazons, the Microsofts, didn't just grow a little bit. They grew so exponentially that their profits easily absorbed the losses of Carolco and the thousands of other dead companies and still pushed the entire market to record highs.
The tail wags the entire dog.
Which naturally leads to the next layer of this mystery. If a tiny handful of tail companies are single-handedly pulling the entire global economy forward, what the hell is going on inside those specific companies?
To understand that, you have to look at how a mega corporation actually functions internally.
I like to think of the global economy like a set of those Russian matryoshka dolls.
The nesting dolls.
Right. The overall growth of the economy is the biggest doll. You crack that open, and you find that the growth is actually just driven by the stock market.
Right.
You crack open the stock market doll, and you find it's driven by just 7% of the companies. But when you crack open those winning companies, What's inside?
More tails. The law of the long tail is fractal. It repeats at every single level of the system.
Let's pull the specific data on two of the largest Matryoshka dolls in the world, Amazon and Apple. We'll start with Amazon. In the year 2018, Amazon alone drove 6% of the entire S&P 500's returns.
And the S&P 500 is an index tracking the 500 largest public companies in the U.S. So out of 500 massive corporations, Amazon alone was responsible for 6% of all the wealth generated.
But Amazon is a sprawling, chaotic empire. They sell books, they make movies, they sell groceries, they build hardware. Was all of Amazon responsible for that 6%?
No.
Our research shows that Amazon's explosive growth is overwhelmingly due to just two internal tail events, Amazon Prime and Amazon Web Services, or AWS.
AWS is the invisible backbone of the internet. It is a wildly profitable cloud computing service.
Yeah, what do Prime and AWS actually do for Amazon as a corporate entity? They act as the 1% tail that pays for the 99% of internal corporate failures. The research specifically highlights the Fire Phone.
Oh, the Fire Phone.
Amazon spent hundreds of millions of dollars developing a smartphone to compete with Apple. They launched it with huge fanfare, and it was a legendary, embarrassing disaster. Nobody bought it. They had to take a nearly $200 million write-down on unsold inventory.
Ouch.
Amazon has also tried to launch travel agencies, restaurant delivery, and localized daily deals. Most of them fail completely. But because Prime and AWS are such monumental compounding tail events, they hide the hundreds of internal duds.
The exact same internal dynamic is visible at Apple.
Apple was responsible for almost 7% of the S&P 500's returns in that same year. And what drives Apple? It certainly isn't their foray into making a car, which they just scrapped after billions of dollars. It's the iPhone. The research refers to the iPhone as, quote, as taily as tails get. It is the ultimate outlier product in the history of consumer technology.
Think about the timeline. Apple spent decades experimenting with personal digital assistants like the Newton in the 90s, various computer models that flopped, and gaming consoles like the Pippin.
I forgot about the Pippin.
Decades of internal failure and iteration. And then the iPhone hits. One singular product out of hundreds of experiments becomes the primary driver for the most valuable company on Earth, which in turn drives the entire stock market. Tails within tails within tails.
It even applies to the humans who built these products. The people working inside these tail companies have what the research calls tail careers. Think about how hard it is to actually get a job at one of these places. Google's hiring acceptance rate is roughly 0.2%.
0.2%.
Facebook's is 0.1%. Apple is around 2%. You are looking at organizations that are built exclusively out of statistical human anomalies who are paid to create anomalous products, which generate anomalous returns for the market.
But this brings us to a massive practical pivot for you, the listener. It is intellectually fascinating to understand how venture capital mutates or how Amazon offsets the Fire Phone. But you are a normal person. You have a 401k or an IRA or just a savings account. How are you supposed to behave when your own personal life savings are strapped to this volatile, unpredictable machine where 40% of the parts are constantly exploding?
Yeah, if the companies I invest in are constantly failing, how do I avoid going broke?
The crucial realization here is that the long tail isn't just an external mathematical force happening to companies. It is an internal behavioral force happening to you. Over the course of your life, your own financial actions will follow a tail distribution.
We have a great quote from Napoleon to illustrate this. When asked to define a military genius, Napoleon didn't talk about complex battlefield tactics or brilliant logistics. He said a military genius is the man who can do the average thing when all those around him are going crazy.
That might be the single best piece of investment advice ever recorded.
Think about how the financial media operates today. If you turn on cable news or open a finance app, the entire apparatus is focused on today. What is the market doing right now? What are the 3 hot stocks to buy this afternoon? What did the chairman of the Federal Reserve say at 2:00 p.m.?
It creates the illusion that every single day is of equal importance, that you constantly need to be making brilliant tactical adjustments to your portfolio.
But the reality of a tail-driven world is that most days do not matter at all. They are statistical noise. Over a 50-year investing lifetime, the financial decisions you make on a random Tuesday in October will have zero measurable impact on your retirement. The research estimates that your lifetime success will be determined by how you behave during perhaps 1% of the time or less.
And that 1% of the time consists entirely of the days when the market is crashing, the headlines are screaming about a depression, and everyone around you is panicking.
To really make you feel the weight of this, our research contains a brilliant 100-year thought experiment. I want to walk through this meticulously because it completely rewired how I view my own money.
Let's do it.
Imagine a timeline stretching from the year 1900 all the way to 2019. 119 years of American history. We're going to look at three hypothetical investors, Sue, Jim, and Tom. Each of them is going to save exactly $1 every single month for that entire 119-year period.
The capital input is identical, $1 a month. The only variable is their behavior in response to economic crises.
All right, let's start with Sue. Sue is the embodiment of Napoleon's genius. She is stoic. She invests her $1 into the U.S. stock market every single month, rain or shine. It doesn't matter if it's the roaring 20s and everyone is rich, or if it's 1932 and the banks are collapsing, or if it's the stagflation of the 1970s. Sue ignores the news completely. She just blindly, methodically buys her $1 of the market.
She does the average thing continuously without deviation.
Now let's look at Jim. Jim considers himself a bit more sophisticated. He is an active manager of his own risk. Jim thinks investing during a recession is reckless. Why throw a dollar into a burning building? So Jim invests his $1 in the stock market when the economy is officially growing. But the absolute second a recession is declared, Jim sells his entire portfolio. He moves it all to save cash, and he saves his monthly dollar under the mattress until the recession officially ends. Once the all clear is sounded by economists, he buys back into the market.
Jim represents the classic market timer. He is attempting to sidestep the pain of the tail events on the downside.
And finally, we have Tom. Tom is perhaps the most realistic representation of human psychology. He's the delayed reactor. When a recession starts, Tom tries to hold on, but after a few months of terrifying headlines, the anxiety gets to him. So he sells out of the market 6 months after a recession begins. And when the recession ends, he's still a bit shell-shocked. He doesn't trust the recovery right away, so he waits to invest back in until 6 months after the recession is officially over.
A very common pattern. Delayed panic on the way down, followed by delayed relief on the way up.
So we have Sue the Stoic, Jim the Timer, and Tom the Reactor. After 119 years of wars, depressions, and booms, how much money do these three investors end up with? Let's look at the final tallies. Tom, who let his delayed emotions dictate his actions, ends up with $234,476.
Not bad for $1 a month.
Not bad. Jim, who actively tried to outsmart every single recession by hiding in cash, does slightly better. He ends up with $257,386. And then we have Sue. Sue ends up with $435,551.
Sue absolutely annihilates the other two. She nearly doubles Tom's return.
She wins by a landslide. But we have to explicitly break down the mechanism of why Sue won. She didn't win because she picked better stocks. She bought the exact same broad market that Jim and Tom did.
She won because of a concept we can call punctuated terror.
Let's look at the timeline again. Between 1900 and 2019, there were a total of 1,428 months. Out of those 1,428 months, just over 300 of them occurred during an official recession.
That is roughly 22% of the time.
Right. So for 78% of the time, the economy was fine, the market was generally going up, and all three investors, Sue, Jim, and Tom, were fully invested, making the exact same moves and earning the exact same returns.
Exactly.
Sue didn't build her massive wealth advantage during the 70% of normal times. Sue's entire outperformance was generated exclusively by how she managed her emotions during the 22% of the time when the world felt like it was ending.
While Jim and Tom were panicking, selling at the bottom, and missing the explosive tail-driven compounding that always occurs at the very beginning of a market recovery, Sue just kept buying.
The research includes a fantastic analogy from the world of aviation to explain this. Pilots often joke that their job consists of hours and hours of boredom, punctuated by moments of sheer terror.
It maps perfectly onto the psychology of long-term investing.
Think about a pilot flying a 747 from New York to London. For 6 solid hours, the plane is on autopilot. The pilot is just sitting there monitoring dials, maybe drinking a cup of coffee. That 6 hours is the 78% of the time the market is normal. It requires almost zero active skill to sit there while the plane flies itself. But then, somewhere over the Atlantic, they hit a massive violent squall. The plane drops 1,000 feet in a second. The alarm starts screaming in the cockpit.
That violent storm is the 2008 financial crisis. or the COVID-19 market crash in March of 2020.
And a pilot's entire career, their success, their survival, their legacy, is not judged by how well they drank coffee during the 6 hours of boredom. It is judged entirely by how they respond to those 3 minutes of sheer terror. Did they panic and pull the wrong lever? Or did they do the average methodical thing while the alarms were screaming?
To bring it to a real-world financial example, how you behaved as an investor during the few terrifying months between September 2008 and March 2009, whether you panicked and sold everything like Jim or held the line and kept buying like Sue. Sue likely had a vastly greater impact on your lifetime financial returns than every single investment decision you made in the entire decade leading up to it.
The behavioral tail event dictates the financial outcome.
So let's tie these massive systemic concepts back to your everyday life, the learner. If a global financial portfolio depends on the ability to stomach a market panic, and if venture capital depends on stomaching a 65% failure rate, then what does that mean for your personal, professional, and creative endeavors?
It means that your success depends entirely on your ability to stomach your own bad ideas. We have to actively, aggressively destigmatize the dud.
We have to stop viewing a failed attempt as a reflection of our core competence.
This is the most liberating section of the entire deep dive. If you have ever felt paralyzed by perfectionism, whether you are trying to write a novel, start a business, or just put yourself out there in the dating pool, this math is your ultimate permission slip to fail. There is a legendary investor named Peter Lynch. He ran the Magellan Fund at Fidelity, which is widely considered one of the most successful mutual funds in the history of finance. And Peter Lynch has this quote, "If you're terrific in this business, you're right 6 times out of 10.
6 out of 10, a 60% success rate. In an academic setting, a 60% is a D-. You are barely passing. And Peter Lynch is saying that a D- is the benchmark for being terrific. It is the absolute peak of human performance in complex systems.
You made a really profound point when we were reviewing this research earlier about how we conflate different types of professions and apply the wrong standards to ourselves.
Yes, we suffer from a category error when evaluating risk. There are certain localized fields where perfection or near perfection is absolutely mandatory. If you are that commercial airline pilot we just talked about, you must land the plane safely 100% of the time.
Right. You can't be like, well, I landed 6 out of 10 flights today.
Exactly. A 60% success rate in aviation means people die. If you are a surgeon, you cannot afford a 40% failure rate on the operating table. But business, investing, creative arts, and even personal relationships, these are fundamentally not aviation or surgery. They are open-ended, tail-driven systems.
And in a tail-driven system, demanding perfection from yourself is actually mathematically destructive. If you insist on being perfect, you will naturally take fewer swings. You will only change projects you are absolutely sure will work. And by reducing your volume of attempts, you drastically reduce your surface area for a tail event to strike.
You guarantee mediocrity by trying to avoid failure.
To really drive this home, our research gleefully recounts the monumental, embarrassing, highly public blunders of some of the most successful billionaires on the planet. I want to share these just to make everyone feel better about their own missteps. Let's look back at Jeff Bezos. We already talked about the Amazon Fire Phone. They spent hundreds of millions of dollars, launched it globally, and it was a total laughingstock.
Intuitively, you would expect a failure of that magnitude to trigger a massive corporate crisis. You'd expect the CEO to be issuing public apologies, firing the entire hardware division, and promising shareholders that Amazon will be much more cautious in the future.
But listen to what Bezos actually told a tech conference shortly after the Fire Phone tanked. He said, "If you think that's a big failure, we're working on much bigger failures right now. I am not kidding. Some of them are going to make the Fire Phone look like a tiny little blip."
That is the mindset of an operator who truly internalizes the long tail. He isn't being defensive. He's almost bragging about the scale of his failures.
Because he knows that it is perfectly acceptable for Amazon to burn hundreds of millions on a bad phone, so long as that culture of relentless experimentation eventually uncovers the next Amazon Web Services. AWS is a tail event that generates tens of billions of dollars. The tail pays for all the blips. This mindset is prevalent across almost all dominant tail-driven companies. Look at Reed Hastings, the co-founder and former CEO of Netflix.
He was once asked at a conference about Netflix canceling several big-budget, highly publicized shows that completely failed to find an audience. You would assume he'd be embarrassed about wasting the budget. But Hastings responded by saying, Our hit ratio is way too high right now. I'm always pushing the content team. We have to take more risk, you have to try more crazy things, because we should have a higher cancel rate overall.
He is actively complaining that his team is succeeding too often. Think about how counterintuitive that is. But the logic is flawless. If Netflix is succeeding too often, it means they are playing it too safe. They are only greenlighting shows they know will get a baseline audience. But if you never take a crazy high-risk swing, you will never stumble upon the massive, culture-defining tail event. You will never find the next Stranger Things or Squid Game. A high cancel rate is a required tax you pay to discover a global phenomenon.
The problem for the rest of us is that we rarely get to see the canceled shows. We rarely get to see the duds.
This brings us to a fantastic analogy from the world of stand-up comedy. The research uses Chris Rock to illustrate the illusion of effortless success. When you or I log on to Netflix and watch a Chris Rock comedy special, what are we actually seeing? We see a flawless, brilliant, perfectly timed hour of comedic genius. Every single premise works, every punchline hits, the arena is roaring. He seemed like a god of comedy.
It looks entirely organic, like he just walked onto the stage, grabbed the microphone, and pure brilliance flowed out of him.
But the research pulls back the curtain on how that specific hour of television was actually manufactured over the course of a year. Long before Chris Rock ever steps foot in an arena with Netflix cameras rolling, he is doing the grueling, humiliating work of generating mutations. In an interview about his preparation process, Rock said, "Before this last tour, I performed in this place in New Brunswick called the Stress Factory. I did about 40 or 50 shows getting ready for the tour."
The Stress Factory, a small, unglamorous comedy club in New Jersey.
A reporter actually went and profiled one of these small club sessions, and it is the exact polar opposite of the polished Netflix special. The reporter describes Chris Rock walking onto the tiny stage, literally thumbing through a yellow legal pad filled with crumpled pages of notes. He's fumbling with his material. He will tell a joke, and it will land with absolute painful silence. And instead of pivoting smoothly, he will just stop, look at his notes, and say out loud to the audience, "I'm going to have to cut some of these jokes."
He is intentionally openly failing in front of strangers.
Over and over and over again. And here's the crucial takeaway. The legendary jokes that you eventually see on the Netflix special, the ones that earn him millions of dollars and define his legacy, those are just the tales. They are the tiny handful of surviving anomalies that emerge from a vast universe of hundreds of bombed punchlines, awkward silences, and terrible premises tested at the Stress Factory.
He operates his comedy routine exactly like a venture capital fund. He expects 65% of his premises to fail completely. But the 1% that crush it will define the special.
And nobody is smart enough, not even a comedic genius with decades of experience like Chris Rock, to preemptively know which jokes will land without testing them and failing first. If Chris Rock can't predict what's funny without failing, why do you expect yourself to write the perfect resume or launch the perfect product on your very first try?
The same illusion of flawless execution distorts how we view the titans of finance. And there is no bigger titan than Warren Buffett.
The Oracle of Omaha. He is the quintessential grandfather of investing. Everyone knows his net worth. Everyone knows the stories of his massive, legendary wins. He bought Coca-Cola, he bought American Express, he bought massive stakes in Apple. These specific victories are endlessly dissected by business schools and financial media.
But what is systematically ignored by that same media is the complete unvarnished record of every single investment he has ever made over his 70-year career.
Nobody writes best-selling books about the agonizing, capital-intensive textile mills he bought that slowly went bankrupt. Nobody talks about the airlines he bought and had to sell at a loss. But those failures are a massive part of the mathematical reality of his success. At the 2013 Berkshire Hathaway shareholder meeting, Warren Buffett admitted something that should be plastered on the wall of every aspiring entrepreneur. He said that over his lifetime, he has owned 400 to 500 different stocks.
400 to 500 distinct corporate bets.
And he followed that up by saying he made almost all of his money on just 10 of them.
10 out of 500. That is a 2% success rate. The greatest, most revered capital allocator in modern human history generated his entire legacy from 2% of his decisions.
His business partner, the late Charlie Munger, immediately chimed in after Buffett said that, and he added, "If you remove just a few of Berkshire's top investments, its long-term track record is pretty average."
That is the raw, undeniable power of the long tail. When we fixate entirely on a role model's successes, we completely blind ourselves to the fact that their immense gains came from a microscopic percentage of their total actions.
And because society hides the failures of the greats, It makes our own failures feel intensely, uniquely personal. When your project flops, you don't think, I'm just cycling through my 400 duds like Disney. You think, I am broken. But the mathematical reality is that you might be wrong. We're just sort of meanderingly average exactly as often as the absolute masters of the universe are.
The billionaires and the geniuses were almost certainly wrong just as often as you are. They simply understood that being wrong is a feature of the system, not a bug.
Which perfectly sets up the final, ultimate rule we can extract from this deep dive. Our research points to a quote from the legendary hedge fund manager George Soros, and I want you, the learner, to burn this into your brain. Soros said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong."
That is the thesis statement for surviving a tail-driven world. The frequency of your rightness is irrelevant. The magnitude of your rightness is everything. You can be wrong 60% of the time like Peter Lynch. You can be wrong 98% of the time like Warren Buffett. You can be wrong 99% of the time like Heinz Berggruen. And you will still achieve generational success so long as the magnitude of your few tail events vastly outweighs the incremental costs of your many failures.
So as we wrap up this journey, let's look at the sheer cosmic scale of the pattern we've uncovered today. We started with Heinz Berggruen blanketing Paris to find a Picasso. We looked at the agonizing grind of Walt Disney's 400 failed cartoons funding Snow White. We analyzed the 40% catastrophic failure rate of the Russell 3000 and how the iPhone pays for the Fire Phone. We saw Chris Rock bombing in New Jersey and Warren Buffett relying on just 10 stocks.
The mechanism is universal. In any complex dynamic system, whether it's biology, markets, or culture tales, drive absolutely everything.
And the research leaves us with one final, incredibly profound thought that zooms out further than anything else we've discussed today. We've talked about markets and art, but let's talk about existence. Astronomers estimate that there are roughly 100 billion planets in our galaxy alone. 100 billion. And as far as human science has been able to prove, well, there's only one planet with intelligent life.
The simple, everyday fact that you are sitting here, breathing, existing, and listening to this deep dive is the result of the longest, most mathematically improbable tail event imaginable.
You are a 1 in 100 billion anomaly. Your very consciousness is the ultimate tale. So I want to leave you with a provocative question to chew on as you go about the rest of your day. Based on everything we've just learned, if the mathematical laws of the universe prove that your very existence, the generational returns of the global economy, and the greatest creative breakthroughs in human history are all dictated by extreme, rare, unpredictable tail events, how much of your daily anxiety are you currently wasting on the 99% of normal, everyday failures that mathematically just don't matter?
It is a question that demands a total recalculation of where we direct our mental energy.
It really is. So, the learner, if you've been banging your head against a wall on a dud project or feeling down about a recent string of rejections, remember Brad Pitt's simple math. Some work and some don't. Don't belabor it. Go out there, take some massive swings, embrace the duds, and we will see you on the next deep dive.